So welcome everyone. Quite a few of you were here this morning, so welcome back. So we had for those who were not here, we had the CIEL Analyst presentation this morning. So we used the same space to save some money. CIEL used to go at NSE or somewhere else. So we are having a presentation today in English. You are all on the screen. So for the first time, we're going to register what's happening, so that we're going to post that on the website. So if people want to refer back to it afterwards, it's possible. So you better have some good questions, and we better do a good job presenting as well. So all right. So we're going to start with. I'm going to kickstart the meeting, giving you some of the highlights on the numbers, then I'll pass on to Jérôme for the financial figures, and together, as well as with Hélène Échevin, who's the CEO of CIEL Healthcare, we will cover each of the clusters, and I'll wrap up at the end. First of all, I mean, you've seen the results that were published on the SAM website this morning. So we have a turnover which has grown slightly to 2.9 billion. We have quite a healthy growth of the EBITDA, somehow boosted also from the change in the IFRS regulations. But a good growth at 2,044 million. Profits was just below the 800 million mark. In fact, it would have crossed, as Jérôme will explain, the 800 million line for the half year if we exclude the movement on IFRS. And quite a healthy growth also in attributable profit at 368 million. And net asset value group-wise per share was slightly down for the year. So quite a positive first 6 months, and I pass on to Jérôme to give you more information on it.
Thank you, Jean-Pierre. Good afternoon, everyone. So, covering the results for the first 6 months of the financial year, we've given you a waterfall, an EBITDA waterfall from the position we were last year in December, after 6 months, to the position we're in today as at the end of December 2019. And what's highlighted on each of the bar chart is the impact of the IFRS 16, which is on leases. You probably, as analysts, well aware. But as far as EBITDA is concerned, it's giving a boost to the EBITDA. It's putting additional financial costs and depreciation, and having a net impact on the bottom line, which I'm going to explain to you. So, as far as the EBITDA growth, we can see that if we exclude the movement from resulting from the IFRS, we've got a growth of 15 million from the textile. We almost are square on the hotel and resorts sector from last year. So no growth really from Sun. On the other hand, the growth is coming mainly from, as you can see, the healthcare and the finance. Finance, the main contributor being BNI in Madagascar, and on the healthcare, CK and Mauritius, which Hélène will cover further down the presentation. Now, on the agri and property side, Alteo, even though the results are slightly better for this semester, I think Alteo released its results on the stock exchange yesterday afternoon. However, last year we had the results which were boosted by an exceptional profit made on a sale of non-core land at Ferney. Ferney being a subsidiary of CIEL. So this year there was no sale of land materializing during this period, so that's impacted on the EBITDA of the group. And at CIEL Holdco we had a sale of investment last year, which resulted in a profit of 20 million, which is not there this year, and some additional finance charges. So on a like-to-like basis, we're moving from a 1.814 to 1.849 billion rupees. If we now move to a similar waterfall for the profit after tax, as Jean-Pierre just explained, we have had a good growth in the profitability for the first 6 months, with profit increasing from 718 to 815 million on a like-to-like basis, i.e. 14% growth if we exclude the impact of the IFRS. However, with the impact of the IFRS, which is pulling down the profit of the group, we're moving down from 815 to 795, and the biggest impact is on Sun, on the hotel and resorts, where we have had 17 million, we're short of 70 million from last year's figures. The growth on profitability coming from the finance, having the same message as for the EBITDA, coming mainly from BNI Madagascar and CIEL in Mauritius, which are the main contributor to this growth. Now, if we look at these bar charts, which represents the revenue per geographical area and the profitability per geographical area, split between Mauritius, Africa and Asia, and compared this period to the corresponding period, the dark blue being the figures for the 31st December 2019, we see a slight drop from the revenue side in Mauritius, compensated by an increase in Africa, which is again BNI growth in net interest income. As a banking operator, this growth has really reallocated the allocation more focused towards Africa. There hasn't been much change in Asia in terms of revenue and profitability. The drop is because, let's say, in absolute terms it has increased, but we're more focused towards Africa. That's why the percentage has dropped in Asia, but in absolute rupees term, there hasn't been a drop from Asia, where, as you know, most of our textile operations today generates their profitability. Now, from P&L, consolidated P&L position, we've mentioned the 2% growth in revenue. We have an EBITDA growth of 13%, but with an impact of the IFRS 16 of 190 million. We've also got a negative impact of the depreciation of IFRS 16 of 100 million rupees. Same message on the net finance costs, which has also had an additional charge from the 1 billion rupee note, which was issued in the beginning of last calendar year, which is in January 2019. So we're getting the full blow this year. In terms of joint venture, the improvements coming from Bank One, who's posted also better results for the semester compared to the prior year. As regard to the share of associates, there are a few of them in the group, but the main contributor of the swing is from RTO, who was in a loss-making position last year as far as profit attributable is concerned, and we take our share of this profit attributable because we own 21% of RTO. So we've gone from a loss-making position to a profit-making position. So the profitability we just covered, and we've got a profit attributable of 368 million rupees for the 6 months, which is 22 cents per share, compared to 19 cents in prior year. We've got more shares in issue this year, so that's why we don't see the 16% increase represented in earnings per share, because for the acquisition or the ramping up in CIEL Textile in July last year, where we took CIEL Textile private, we issued shares to the minority shareholders of CIEL Textile. So it was partly cash, but partly shares. We're now moving on the group balance sheet. The focus is mainly on the debt. So the net debt of the group today stands at 16 billion rupees, up by almost 500 million from the June position, explained mainly by two factors. There's been a bond issue at CIEL Finance level to finance an investment in Bank One and to refinance itself, and also a further issue at CIEL to finance the ramping up in CIEL Care and CIEL, because you are aware that CIEL acquired a 20% stake in CIEL at the beginning of this financial year. So we currently have a gearing of around 42.4%. The debt to EBITDA is decreasing. As we can see, we're moving down from 8.1, which was a peak in June 2017, we're now down to 4.4. To compute this ratio, we've annualized the EBITDA, so the December 19 figure here is a 12 months period to December. So you won't find it in the financial because we're reporting on a 6-month period. But for the computation of this ratio, we use a 12-month period. And the debt allocation within the group, Sun accounts for 50%, so 8 billion of it is on Sun balance sheet. CIEL Textile, which is mainly working capital financing, accounting for 23%. And the other one is CIEL, the Holdco, who has an indebtedness of around 2.9 billion rupees, made up mostly of notes. Now on the portfolio of CIEL, we have had an increase of 2% in absolute terms, because we have had an investment, as I mentioned before, in CIEL and CIEL Textile. So we've increased our investment in the portfolio by 665 million rupees. However, as you can see, this increase from 14.1 billion to 14.4, we have had a negative impact on the portfolio value from the fact that Sun and Alteo have lost during the 6-month period to December 15 and 11% of their value on a stock exchange, whilst CIEL has increased by 4% during this period. In terms of portfolio allocation, we have, as of December, around 30% in textile. Hotels is down from 24 to 20. Finance is maintained around 20%. Agro and property 21. And the healthcare, with the additional investment we've made, is gaining momentum in the portfolio and today accounting for 8% of the portfolio. Last but not least, on the key financial figures and market data, I wanted to show you this graph, which shows the movement in the share price from June 2016 to date. Well, it's not really to date, it's to December 2019. As we know, currently it's around 540. It's at 540 today. In terms of NAV, we've posted the group NAV, which is the blue line, and the dotted line is the company NAV. So we can see that the group NAV, the discount to the group NAV is around 27%, and to the company NAV it's 18%. So we're trading at a discount, and we've also given it the bar chart, the improvement in the profitability over the last few years. Of course, we didn't put the 6-month results because I think really for this comparison we need a 12-month period. And I didn't want to annualize the last 12 months because I don't think it's representative of the forthcoming 6 months for the forthcoming financial year. So that's the key highlights as far as financial is concerned. We're now going to move into the cluster review as the chair, as the group CEO has just mentioned. I will cover the agro and property. So agro and property for CIEL, it's 21% stake in Alteo, listed company, and the two main components, and 72% stake in Fairney Limited, who owns land close to the airport. So we can see that the contribution from the agro and property sector is pretty slim for this period. We've only had, in fact it's putting slightly down by 3 million, compared to 37 million of profit last year. Last year, as I mentioned before, we had an exceptional gain from a sale of land at Fairney. There was a substantial piece of land in Bois des Amorettes which was sold, which resulted in a profit. This year, up to now, we haven't crystallized any sale of non-core land. But as I explained also, this shortfall has been somehow mitigated by the fact that Alteo has had better performance for the 6 months. So our share is around 8 million rupees compared to a loss of 7 million last year. Now, as regard to Alteo, if you read the communiqué last year, yesterday afternoon, you will note that the situation is still very challenging, of course, and not much changes from the last quarter reporting. However, the losses in Mauritius on the Mauritian sugar operations been slightly reduced because they managed to get a better sugar price this year, even though the sugar revenue per ton has decreased, because last year There was this government support through either this SIFB and the Bagas Fund, which is up to now, no incentive has been announced. So the sugar revenue per ton is decreasing, but Alteo has had a better crop with better sucrose content. So with this additional sugar production is mitigating these losses. The good performance over the last few years, and the same message for this semester, is Tanzania, whereby the sale mix for the period has mainly been on sugar sold locally, which has a higher margin than imported sugar, because Tanzania also imports sugar, TPC, for the shortfall on the local market. And compared to last year, so we've been able to achieve a better sales mix, and also the sugar price has been picking up in this region of Africa. So higher margins, which is helping and certainly contributing to Alteo's results. Kenya is still a challenge. Production is slightly down on the corresponding period of last year. There has been a factory maintenance of 3 weeks during the month of November, which was not, which hadn't occurred in the previous period. So these 3 weeks has affected the production, and the prices also have been slightly lower than the corresponding period. So the profitability has been impacted, or in fact, the loss, as you've seen, somehow higher than in the previous period. Good news is from the property, be it on non-core land from Alteo or from the Anaita project, whereby sales are still picking up and doing very well. So it's enabling Alteo, through the cash it generates, at least from the non-core land, to finance its restructuring and finance the operating loss, whilst Anaita is bringing down its indebtedness, and hopefully will position Alteo in forthcoming years to be able to bring up some cash. So that's mainly the results from this cluster. I will now pass back to Jean-Pierre, who's going to cover the remaining clusters, and subsequently to Hélène. Thank you for your attention.
Merci, thank you, Léo. So if we can now move to CIEL Finance, CIEL Textile first. So we had a turnover which is slightly below last year, and I'll explain to you why. So at 6.4 billion. EBITDA, however, was slightly higher, therefore translating in better margins, and the bottom line at 302 million, so a growth from 277 million last year. So essentially, looking at the geographical position, we can say that our positioning in Asia has done particularly well, whereby the region, so Madagascar and Mauritius, suffered this last semester. So we are in a position where India is perceived as very well located for apparel sourcing worldwide, with what's happening in China. I mean, not on the latest virus information, which can only reinforce that, but on the tariffs that were imposed, albeit being reduced from 15 to 7.5%, but still higher costs in China and more duties is pushing more trade to India, which is really a center for purchasing for these large international retailers. So it's been pretty good, but not as much impact here in the region. So this is essentially the trend that we are noting. And the woven segment continued to do well. And the positive news is that the recently launched factory called in Samudra, about 2 hours away from Bangalore, has started very well, and it's eco-friendly factory. It's quite impressive results coming out from India. The other point is that we have more high-end customers which are doing well, so that's a positive news. However, we know that the retail industry and the traditional retail operators are facing difficult times, especially so in Europe, but also to some extent in the US with what's happening in terms of more digital sales. So this is something we have to watch and management has been able to push more sales towards higher-end customers, and also more towards sales online, which is a key for our future. On the niche segments, so it's been rather positive in terms of results. We've had some issues with the operations that we managed to get compensated upon by the insurance. And on the engine side, our factory, which was launched about 3 years ago in Coimbatore in India, is still, although it's progressing, is still facing some difficulties. And in fact, we just announced some management restructuring so that the Tropic Knits India factory is going to come under supervisions of the woven cluster operations in India. So we should get some synergies out of that, and some good drive in terms of experience from the management team, which is based in India for CIEL Textile since about 15 years. The knitwear segment, so we still have Bangladesh doing well over this semester, and we see clear improvement on the Antirabe and Tananare factory, but mostly on the Antirabe factory for Floreal Knitwear. So that's rather a good sign, and also very important, a much improved customer satisfaction. So that's rather positive for the knitwear business. Now moving on to CIEL Hotels and Resorts. So most of you were at the Sun presentation this morning, but nonetheless I see that some faces were not here. So I'll give you a bit of a heads up on Sun. So with the environment is difficult in Mauritius. We have a reduction in tourist arrival. I would say that despite this, the results of Sun have been pretty resilient. The more so that the Sugar Beach hotel was closed for most of that semester. It reopened effectively fully about the 10th of November, and it was able to operate over the peak season. But there is a refurbishment which is going on, so part of the inventory had been closed over these 6 months. We also had a negative impact from Thomas Cook, so of about 15 million rupees, and we have an impact on the IFRS to the tune of about 17 million rupees over the semester. So results which are, I would say, in line with last year, but quite impacted by the Sugar Beach, which is going to complete its renovation in the low season in between May and September of the coming year. The peak season was quite affected by the cyclonic conditions, but most of you witnessed here. So unfortunately, that has affected, to some extent, the Four Seasons particularly, which has a very high revenue, at that time of the year. We note a very good performance of the Shangri-La, which seems really to be taking off, so that's pretty positive. Very strong performance of La Pirogue, Sugar Beach I mentioned. Ambre also did much better. However, the two hotels which are posing quite a challenge for us is the Long Beach and the Kanuura Hotel in the Maldives, which faced quite significant room inventory coming onto the market. So the RevPAR for most of the hotel companies in the Maldives were down over the period, and Kanuura also suffered to some extent, but nonetheless showed a growth in revenue. So what I would add for Sun is, total RevPAR progressed by 6%. Which is pretty healthy, in line with what's happening at the Sugar Beach level. Now there was quite a few questions after the session, the presentation by management this morning on what's happening currently with the coronavirus. It's very difficult to assess right now. With management as in its forecast taking into account an impact. That said, I think the next 2 months is going to to see really what's the full impact of that. The Chinese business for the Mauritian operations of Sun Resorts, it's under its brand, is not very significant, but it's quite important for the Four Seasons. So, but most of the business, the Chinese business, occurs during the low season. So we do hope that the situation will clarify at least before we get into April, May. But to be seen, so management is now working on alternative to compensate that Chinese business. The Kanura, which is, as you know, the Maldives, is very dependent because having about 20% of the arrivals of the Maldives, if not a bit more, is from China. Fortunately for us, the Kanura is very low in the Chinese business. It's really focused on the European business. So I think the impact will be there, maybe not as much as for some other hotels operating in that country. But that said, there will be probably a lot of competition to tap that same market. So bookings, we were very positive on Q3. They are ahead of last year. What's happening in the world right now, we'll need to see how that is going to evolve over the next few weeks. Sorry, I missed CIEL Finance. So we had a good first semester for CIEL Finance, mostly on the banking front. So good results from first of all BNI in Madagascar, which is really now firming up to take the leadership position in the banking world of Madagascar. So it's growing its market share to 23-24%, and it's number one in corporate banking. We have about to have the largest number of agencies in Madagascar, and strong push on the mobile banking. We launched the fully digital microfinance company called CRED, which is, we believe, extremely promising for the future. So overall, strong thrust, a catch up in profitability compared to its to the peers there. So that's we know exactly why the profitability is a bit lower than the competition. So we see quite an immediate catching up happening over. I mean, this half year was very positive, and we see that carrying on in the coming in the current semester. So we are very bullish, I must say, on BNI in Madagascar, in an industry which is resilient even in politically difficult times we know the country can face. But so far we see Madagascar really moving in the right direction. So we, as I said, positive about it. Bank One also had some good results, best results ever, and so we have a change in the CEOship. There's quite a few new people also in the top management. The person taking over is Mr. Mark Watkinson, who comes from HSBC and has got a strong banking experience, and we are quite convinced that he's set on the right path as far as Bank One is concerned. So good growth in results, and I think since there was in our third quarter, but the last year of Bank One, quite a big exceptional item that hit the account of Bank One in our Q3. So in the coming quarter, this will not be here, hopefully this quarter, so that should be quite healthy as we move along in the year. So at CIEL we are very positive about pushing further that sector. Now I'll pass on to Hélène on self-care.
Merci. Good afternoon, everyone. So maybe a bit of a deep dive on the healthcare sector. So first, to explain to you, our greater purpose is really to improve the quality of life of the people we serve in our region, definitely. Our vision is to be the best healthcare operator in East Africa, in our region. And our mission is patient first, and definitely delivering medical services and passionate care we can all feel proud of. Just as a reminder, I guess you know, but as a reminder, so CIEL Healthcare Limited is the holding company based in Mauritius, And we have investment in Mauritius, Uganda, and Nigeria. We operate primary care and secondary care centers, tertiary care, and laboratory. So for the one who doesn't know the difference, primary care, secondary care is really where you don't operate complex cases. Tertiary is when you go into complex cases. Our investment portfolio, so CHL, so CIEL Healthcare owns 57% of CCare, but there CIEL also owns part of it. So together CIEL and CIEL Healthcare owns 88% of CCare Mauritius. We own 90.1% of IMG in Uganda and 22.8% of our Nigerian investment. CIEL Healthcare Africa is a very small company, offshore company. In the entire portfolio, we have 5 main hospitals, so tertiary care. So we have 2 in Mauritius, Dane and Welkin. We have 1 in Uganda, and we have 2 in Nigeria. We have also 19 clinics. A clinic for us is kind of the setup we have at La Croisette. We have 1 at La Croisette. We have 17 clinics in Uganda, and we have 1 clinic in Nigeria. Overall, the entire portfolio accounts 453 beds, but the investment we control have 363 beds. We have 358,000 enrollees, so HMO, a health insurance member. Part of it in 300 is Nigeria, the rest is Uganda. We have more detail on Uganda later on. We have 3 main laboratories, 2 in Mauritius, 1 in Uganda, and we have collection centers. These are places where we take the blood and we send it to the central laboratories. In Mauritius we have 6, the rest is in Uganda. Now I'll focus more on the asset we do control, so Mauritius and Uganda. So our brands are, from the hospital perspective, we have Dane, Welkin. As a reminder, we have rebranded the Mauritian activity last year. And in Kampala, we have IHK, which is our hospital in Kampala. In terms of clinic, we have C Clinic, so in the north, and we are opening soon in the west, small clinics. And the network in Uganda is called IMC. This is our bigger network. Laboratory, we have rebranded CLab. Before, this was not treated as a specific business unit in the CCare portfolio, but since last year we have rebranded CLab under CLab, and we have open collection centers in Mauritius. And we have a company who is trading pharmacy product in Uganda. Our shareholders, partners are Proparco, IFC, IFA. IFA is a private equity fund from Holland, and Kibo that you know. Key element on our operating context. So our opportunities in the healthcare sector is that the rising middle class obviously is our customer of tomorrow. So in all the countries we are operating today, this middle class is going up. So there's a growing demand in private healthcare because this rising middle class, but also because the government are facing a lot of difficulties to continue to invest into healthcare. In Mauritius, we have really taken some advance compared to the competition because now we have Welkin and Dane, and both the assets have a capacity to increase the number of beds at, I would say, a minimal cost compared to any kind of competitor getting into the market. The barrier to entry in our business is very high. Just a quick word, in our world, the operating theater is a key element of our hospital, and today in both Mauritius and in Uganda, we are using our operating theater at 60%. So the capacity to grow is quite big by adding new beds. So barrier to entry for the others will be a problem. And this is what I said. So we, at Welkin, for example, is just by adding bed, we are easily able to cope with the demand. Our risk is that mainly in East Africa, it is the ability of the patient to pay. The insurance penetration is below 3% in those countries compared to Mauritius, which is around, let's say, 27-50%. So this is for us our main risk because the people can't pay for the service. Access to talent. We are in a world where having the resources to invest in the building and the equipment can be found, but this is the nurses and the doctors. So in the country where even in Mauritius, have access to the nurses is not that easy, and places like Uganda or Nigeria, it's not that easy to have good doctors. Then we have faced during the last month some rising cost in the human resource in Mauritius with the new law that you are aware of, and in Uganda also, specifically in the healthcare sector, the government have raised the salaries last year quite significantly. I would say that our strategic direction in 3 big balls is first to consolidate CIEL Mauritius in terms of financial results and operational excellence. The second big ball is really to turn around our African operation and then to continue our expansion in East Africa. Some key numbers. So the revenue has grown this year compared to last year by 16%, with an EBITDA margin that has also greatly increased, and a profit after tax who from a loss is now on a profit position. Mainly driven, I would say, by Welkin, and the revenue also driven by Uganda. So if we now focus on CIEL Mauritius, we have a 10% increase in revenue. We have higher occupancy both at Dane and Welkin, which is good for us because we were fearing that maybe Welkin would take over on Dane, but it seems that both are still doing well. Our occupancy, as you can see, obviously the gap is, the improvement is better at Welkin, but Dane is still there. So this is for Mauritius. If we look now in Uganda, so here we have 38% increases in revenue, which is good. We have done some investment during the year in equipment to put into the hospital to really bring back the doctors and the patient to the hospital, so it's starting to pay. The occupancy in the hospital has really increased from 50% to 64%. This is the heart of our business. The clinic also, the visit, have increased from by almost 30,000, I would say, with organic, but also we have increased the number of clinics. So it's both that has brought the growth. And the number of enrollees on the HMO business, sorry, I'm not sure everyone is saying, went from, or increased about 6,000 for the half year. So this is compared to last year. So this is for Uganda. So moving forward, as I said, obviously consolidation of our existing asset, turnaround of IMG mainly and Nigeria, continue our focus on quality and patient experience because this is really where we want to make the difference. We really want to certify our hospital first in Mauritius. For me, it's a very strategic differentiation because none of the governmental nor private hospital in Mauritius are certified, and we believe that this will put us in another league. So we have a partner with a UK company. They are specialized in hospital certification. So we are targeting the certification in 2 years from now. And then in terms of expansion, the expansion will be mainly in Mauritius for the coming months. So we are opening a small center in Tamara in a few weeks from now. We are also adding 16 beds in Welkin that will be completed by end of April. We are deploying the C-Lab Collection Center. So now we have 2 in the west, 1 in the north, 1 in Quatre-Bonnes, and 1 in Eben. And we have normally 2 more to come before the end of the year. By next financial year, we will relocate the center we have in the north and increase the offering and the services. Today it's quite limited, so we are moving the center. We have also decided and board accepted the expansion of Darnay. So we are building a new building close to Darnay on the same piece of land. To really expand Darnay, there's a need there. And in that new building, we are also starting a cancer unit with some partners from abroad, and that will be launched at the end of 2021. So this is, I would say, the main big project for the coming months and years. I think I covered almost everything. So I don't know if we are taking the question on.
Let's take the questions afterward, I propose. Okay. Yes. Thank you, Ilan. Exciting sector as well. And stable. Well, normally in terms of revenue, it's we see that in other countries, it's gradual growth, and with a country of a type of economic development we have in Mauritius, that's something we can rely on, but healthcare is going to have a steady growth. So just a few words to conclude. Well, I think we had a particularly, especially on the profit after tax and profit attributable, quite a good growth. So essentially better net margins, solid performance of CIEL Finance I just talked about, as well as the textile business, but more so in Asia. We are very pleased about the turnaround of healthcare. So that it was an important investment we made in Welkin, and pleased to see that now we are coming into profitability, and we look forward to further growth in that respect, and a resilient performance in a challenging environment for the hotel and the agro sector. So just a few words on what we're doing and what we feel is very important is for us to really track the cash flow of the CIEL Group and monitor the EBITDA performance versus the debt. So as Jérôme pointed out, there is we're improving in that direction year on year, and we keep on focusing in that respect. We are starting the property cluster. We've nominated a new CEO. We'll take that fully on board. We have an expert that has joined us since a few months now. So we're setting up CIEL Properties as something which is going to be very active to really make sure we can get a better turnover on our assets, which is significant. So we want a better return on assets. That's key for us. We're pushing operational excellence. We have committees at each of the companies focusing on operational excellence. That's key for us. And we also, at group level, have initiated innovation awards, which is also tracking the progress we're making on the digital front, but innovation at large. It has to be really coming from all levels of the organization. So strong push on that, and these awards or these events are also driven within each of the clusters now. So that's I think that's very positive. We noted growth in profitability from Africa more so than in Mauritius. We still, I believe, we are one of the Mauritian groups which is most present outside of Mauritius, and we want to keep on capitalizing on emerging market growth. That's definitely our intention. Talent is the key. So we had over 2019, HEC designed a tailor-made program for our top talent, and we're entering the second batch now of our top talent who are going to be trained during this financial year. So we have people from HEC coming and doing the training here. We're launching an international graduate program. We're tapping people internationally so that we can young talent straight out of university and specialized university to come and join, and we can progress and with them and make them progress. And we're also setting up a partnership on the nursing front at the level of CIEL. So customer satisfaction is very important. So we've ensured that we really measure net promoter scores and things like that within each of our clusters. So we have a number of KPIs which applies to each of the clusters, which we're now monitoring right away up to the CIEL board, so that we don't look only at financial performance, which is a resultant of everything else what is done. So stronger focus in that respect from management and at all level of a company. And we also similarly measuring progress made on the digital front. Very important to see how we can improve processes, get better productivity, and better customer satisfaction through various digital means. And last but not least, it's sustainability. So I'm very pleased to announce with Mathieu, who's spearheading that, and Xavier also will be here, that we've set a clear strategy. And I think probably for one of the first companies, at least in Mauritius, to set clear targets, measurable targets in terms of carbon footprints and a number of data that we can measure group-wise. And we've set ourselves, that was approved actually yesterday at board level, some very interesting targets which we'll be working to achieve in the years to come. So you'll hear more about that in the coming months. And so looking how we grow further, CIEL, definitely, as I mentioned, we see that we would like to tap more of the profits that we're making in financial services, be it in Mauritius and in Madagascar. So we're going to carry on, pushing that to get better attributable profit from that area. CIEL Textile, as I briefly mentioned, is well positioned, going forward to be really a partner of large international brands, which we are already. But there's going to be a strong shift outside of China, which China represents about 35% of the total apparel exports worldwide. I think it's about 275 billion. So this is very small compared to, the production made out of India is still relatively much smaller, and the region here even smaller. So it's interesting to note that the Southeast Asian region is also impacted by the coronavirus, and we are as well to some extent. But the fact that we are integrated in the region is a plus, but we still import some materials and trims from China. So we need to manage that in the current situation. It's managed relatively well. And in India, we source everything from India. So I think we have a good position that we can capitalize on, and we're going to make sure that the team carries on focusing on that. At Sun, most of you heard François Hainaut this morning. So strong push on sales and marketing, the new recruitments that have just been made, some already in place, some happening in April. And he sees that we can really make a significant difference at that level. So we look forward to his new management input. The new property cluster, so this is now launched. We have a clear business plan. We've worked on the strategy, and really we want to see more dynamism in terms of return of assets on assets at the level of CIEL. And at the level of Alteo, also we need to make sure that we have a sustainable business plan with what's happening in the sugar front, especially so in Mauritius. I think the problems of Kenya are probably shorter term, and we hope to solve them quite rapidly. Tanzania is doing very well. So we're working very closely with IBL and the management of Alteo to ensure that we have an interesting business plan and make sure that we can extract the strong property positioning that Alteo has in Mauritius. And finally, our ambition is to be positioning companies which are leaders in their field, be it in the regional front as far as banking or, depending on their market share. We really want to see investments in companies which can really be number one or number two in the sectors in which we operate. So that will be our strategy. We'll keep on developing that going forward.